I want you to pull up your banking app right now and look at that number in your primary checking account. Let's say it is $20,000. For most of us, that number feels like a warm blanket on a cold night. It is your emergency fund, your house down payment, or just the psychological floor that keeps you from panicking when the car makes a weird noise. It is FDIC insured, it doesn't fluctuate like the stock market, and it is right there whenever you need it. But I am here to tell you that this feeling of safety is one of the most expensive illusions in modern finance. While that $20,000 looks perfectly still on your screen, it is actually bleeding out. You are currently paying what I call the checking account tax. It does not show up on a monthly statement, and no politician will ever mention it in a debate, but it is siphoning off your wealth with surgical precision. Every single day you leave that cash sitting there, the bank is quietly draining about 4% of your purchasing power every year. You aren't losing the dollars themselves, but you are losing what those dollars can actually do for you. By the time we are done today, you will see exactly how that $20,000 becomes $10,000 without you ever spending a dime. Before we dive into the math, I want to ask you for the best return on investment you will get today. If you find this breakdown helpful, consider hitting the like button. It tells the algorithm that financial literacy matters, and honestly, it is the only tax-free transaction we will discuss today. Now, let's talk about the mechanics of this theft. Traditional banks have mastered the art of consumer inertia. They pay you a yield so low it is essentially a rounding error, while they use your money to generate massive profits. This gap between the microscopic interest they pay you and the actual rate of inflation is the checking account tax. We are going to look at the two opposing forces that determine your real wealth: inflation and annual percentage yield, or APY. Most people only look at the APY, but that is like checking the score of a game without knowing which direction your team is running. If your bank gives you $1 in interest, but the price of eggs goes up by $5, you didn't gain a dollar, you lost 4. Today, I'm going to show you how to stop that leak and turn your cash from a stagnant liability into a productive asset. To understand the tax, we have to look at the heavy lifter in this scenario, which is inflation. Most people think of inflation as just prices going up, but I want you to think of it as your money shrinking. The Bureau of Labor Statistics tracks this through the Consumer Price Index, which is just a fancy way of saying they watch the price of a basket of stuff, like housing, food, and gas. When we say inflation is at 4%, it means that same basket of goods that cost $100 last year now costs $104. If your cash hasn't grown by that same 4%, you have effectively been demoted. You are working just as hard, but your money is lazier than it was 12 months ago. Even when the Federal Reserve targets a 2% rate, history shows us that spikes are common, and the long-term average often sits much higher for the things we actually need, like healthcare and education. This is the first half of the checking account tax formula. It is the steady, relentless upward pressure on the cost of living that makes your $20,000 buy fewer groceries and fewer gallons of gas every single time you go to the store. It is a silent predator that relies on the fact that you aren't looking at the real value of your money, only the nominal number. Now let's look at the second half of the formula, which is your annual percentage yield. If you are with a big national bank, your checking account probably pays an APY of 0.01%. I want you to really think about that number. That means for every $10,000 you let them hold, they reward you with exactly $1 per year. It is not even enough to buy a cup of coffee anymore. In fact, if you account for the paper they use to mail you a statement, they are probably losing money just telling you how little they are paying you. This is where the trap is set. The bank knows that as long as they give you something, even if it is a fraction of a penny, your brain registers it as a gain. But when we combine these two forces, we get the real interest rate. You take that tiny yield and subtract the inflation rate. If the bank pays you 0.01 and inflation is at 4%, your real interest rate is negative 3.99%. You are essentially paying the bank 4% a year for the privilege of letting them use your money. If a bank physically reached into your account and took out $800 every year and called it a maintenance fee, you would close the account tomorrow. But because they take it from the value instead of the balance, most people just let it happen. There is a psychological reason we don't notice this theft, and economists call it the money illusion. It was coined by Irving Fisher about a century ago, and it describes our tendency to think of money in absolute terms rather than what it can actually buy. Our brains are wired to see $20,000 as a fixed unit of value. We think $20,000 is $20,000, period. But money is not a fixed unit, it is a moving target. Because the digits on your screen don't change, your amygdala stays calm. You don't feel the sting of the loss. This is exactly what the banking industry counts on. They rely on the fact that you will prioritize the visual stability of a checking balance over the actual health of your purchasing power. If we saw our bank balances in terms of loaves of bread or gallons of milk, we would be terrified. We would see that $20,000 balance slowly turning into 19,000 loaves, then 18,000, and eventually 12,000. The money illusion is the fog that allows the checking account tax to exist. It turns a guaranteed financial loss into a perceived safe haven. To get past this, we have to start thinking in real terms, not nominal ones. We have to look past the digits and see the utility of the money. Now, you might be thinking that 4% doesn't sound like a catastrophe. It is just a few $100, right? Well, if you think this is a slow drip that you can ignore, wait until you see what happens when we project this over a decade or two. We are about to look at a $20,000 scenario that will fundamentally change how you view your bank balance. If you have ever wondered why some people seem to get ahead while others just stay level despite saving every penny, this next part is the answer. We are going to visualize exactly how the world moves forward while your cash stands perfectly still. This is the difference between having a safety net and having a net that is slowly rotting away while you sleep. Most people realize this far too late, usually when they go to make a big purchase and realize their savings don't go nearly as far as they used to. We are going to run the numbers so you don't have to experience that surprise firsthand. Let's look at the timeline of a $20,000 stagnation. Let's take your $20,000 and leave it in a standard checking account for exactly 1 year. You are responsible, you didn't spend it, and you feel great. At the end of the year, the bank sends you a notification. They have deposited your interest. Your new balance is $20,000 and $2. You might even feel a tiny spark of satisfaction. But let's look at the real world. Over that same year, inflation has been a steady 4%. That means the car you wanted that cost $20,000 last year now costs $20,800. Your $2 in interest is mathematically insulting. In terms of purchasing power, your $20,000 is now worth about $19,200. You have lost $800 of utility. That is a high-end laptop, a month of high-quality groceries, or a significant car repair that just evaporated into thin air. You didn't buy anything, you didn't lose a bet, and you didn't get robbed in the street. You just sat still while the cost of existing moved up. This is year 1, the silent bleed. It is the moment where the gap starts to open, and for most people, it is the only year they consider before they decide to keep their money in a big bank. Now, let's fast forward 5 years. You still have that $20,000, and your bank balance now reads $20,010. You have earned enough interest to buy a sandwich. But in the real world, The cumulative effect of 4% inflation has been devastating. Your $20,000 now only has the purchasing power of about $16,400. You have lost nearly 20% of your wealth. If this money was meant to be a down payment on a house, you are now much further away from that goal than you were 5 years ago, even though you saved the money perfectly. By year 10, the situation becomes an emergency. Your nominal balance is $20,020, but its actual value has plummeted to $13,500. You have lost a third of your money's power. Imagine working for 10 years to save $20,000, only to find out that while you were working, the world decided your effort was only worth $13,000. This is why saving in a checking account is actually a form of gambling. You are betting that the cost of living will stay flat, which is a bet that has never paid off in the history of modern economics. You are trading the volatility of the stock market for the guaranteed loss of the checking account tax. It is the most predictable way to lose money ever invented. Einstein supposedly called compound interest the eighth wonder of the world. He said, "Those who understand it earn it, and those who don't pay it." When you leave cash in a low-yield account during inflation, you are paying reverse compound interest. Let's look at the 20-year mark for that $20,000. Your bank balance will show $20,040. But its real-world value? It is now worth $9,100 in today's money. In 2 decades, the checking account tax has claimed more than half of your wealth. You did everything right on paper, but you ignored the plumbing. Meanwhile, what was the bank doing with that money? They didn't let it sit in a vault. They lent it out for mortgages at 7%, auto loans at 9%, and credit cards at 24%. Or they simply parked it at the Federal Reserve to earn a risk-free 5%. They took your $20,000 and used it to compound their own wealth while you took the full hit of inflation. They grew their buying power using your capital, and they paid you $40 for the privilege. This is the core business model of traditional banking. They are in the business of capturing the spread between what money earns and what you are willing to accept. As long as you accept 0.01, they will keep the rest. To stop being a victim of this system, you have to understand it from the bank's perspective. When you deposit money, the bank doesn't see it as an asset. To them, your deposit is a liability because they owe it back to you. Their assets are the loans they give to other people using your money. This is where the net interest margin comes in. This is the holy grail of banking. It is the difference between what they pay you and what they earn by lending your money out. In a high-rate environment, the Federal Reserve might set interest rates at 5%. The bank can take your $20,000, put it in a government bond or a reserve account, and earn $1,000 a year without breaking a sweat. They give you $2 and keep $998. That is a massive margin. When interest rates go up, banks are lightning fast at raising the rates they charge on your credit cards and mortgages. But they are notoriously slow at raising the interest they pay you on your deposits. This is what's known as deposit stickiness. They know you probably won't leave just because the rate is bad, so they keep the extra profit for themselves. You are essentially providing a zero-interest loan to a multi-billion-dollar corporation. Before we get into the step-by-step protocol to fix this, I want to invite you to join a specific group of people who are tired of these invisible leaks. We call them the optimizers. If you click the Join button below, you can become a channel member. You get priority comment replies from me and a custom badge that shows you are someone who actually looks at the math. This community is for the people who want to move past basic advice and actually master their financial plumbing. It is a great way to support the channel and ensure I can keep making these deep dives without needing to sell you a soul-crushing credit card. We are trying to build a collective of financially literate rebels who don't just accept the default settings the banks give us. If that sounds like you, I would love to see you in the members-only area. Now, let's talk about the psychological wall that keeps your money trapped in that checking account. Even when people see the math, they often hesitate to move their money. Why? Because of a cognitive bias called loss aversion. Behavioral economics shows us that the pain of losing $1 is twice as intense as the joy of gaining $1. When we think about moving money out of a checking account, our brains perceive it as a risk. We think, what if the new bank is hard to use? What if the market crashes? What if I need the cash this afternoon? We are so afraid of a visible nominal loss that we ignore the invisible guaranteed loss of inflation. We trade the possibility of a market dip for the certainty of a purchasing power drain. This is a fundamental misunderstanding of risk. Keeping $20,000 in a checking account is not zero risk. It is a 100% guaranteed risk of losing value. You aren't playing it safe, you are opting into a slow-motion car crash. Another issue is mental accounting. We label our checking account as the safe bucket. Because it is labeled safe, we let it grow far beyond what we actually need for monthly bills. We think a high balance means we are winning, but it actually means we have a lot of dead equity. Your checking account shouldn't be a storage vault. It should be a clearinghouse. It is a train station, not a parking lot. The most immediate way to kill the checking account tax is the high-yield savings account, or HYSA. These are usually offered by online banks that don't have the massive overhead of physical branches and marble lobbies. Because they don't have to pay for prime real estate and thousands of tellers, they can pass that yield back to you. While a big bank pays 0.01, an HYSA might pay 4.5 or 5%. Let's look at the difference on your $20,000. In a big bank, you earn $2. In an HYSA at 4.5%, you earn $900. That $900 is a direct shield against inflation. It covers the $800 loss we discussed earlier and actually leaves you with a small real gain. The best part is that these accounts are still FDIC insured and highly liquid. You can usually move your money back to your main checking account in a day or two. There is no reason, other than the lazy tax, to keep your excess cash in a standard savings account. Opening an account takes 5 minutes, and it doesn't affect your credit score. It is the lowest hanging fruit in personal finance. If you haven't done this yet, you are choosing to pay a $900 convenience fee to your bank every year. Stop doing that. If you want to get even more efficient, you look at treasury bills and money market funds. Treasury bills are short-term debt from the US government. They are often called the risk-free rate because they are backed by the full faith and credit of the government. They have a massive advantage that HYSAs don't. The interest you earn is exempt from state and local taxes. If you live in a high-tax state like California or New York, a 5% T-bill is actually better than a 5% savings account because you keep more of the profit. Then there are money market funds, which you can find at any major brokerage like Vanguard or Fidelity. These funds invest in very safe, short-term things and often pay even higher yields than savings accounts. This is where the big institutions park their cash. By using a money market fund, you are basically getting the same deal the big players get. You can move your money in and out easily, and the yields often track the Federal Reserve's rates almost perfectly. This is how you stop being a customer and start being a capital provider. You are no longer the person the bank makes money off of. You are the person who is capturing the yield for yourself. When you combine these tools with a smart system, you become immune to the checking account tax. You turn the math of the banking world in your favor, ensuring that your $20,000 grows as fast as the world around it. So, how do we actually fix the $20,000 problem today? We use what I call the hub and spoke system. Your checking account is the hub. Its only job is to receive your paycheck and pay your bills. You need to calculate your monthly burn rate, which is the total cost of your life for 30 days. Let's say that's $4,000. You keep a buffer of 1 to 1.5 times that amount in the hub. So, your checking account target is $6,000. Every single dollar above that $6,000 is dead weight. It needs to be evacuated. This is where the spokes come in. Spoke 1 is your high-yield savings account. You move $10,000 there. That is your core emergency fund. It is safe, liquid, and earning interest. Spoke 2 is your opportunity fund, maybe in a money market fund or T-bills. You put the remaining $4,000 there. This is for future purchases or buying the dip in the stock market. By doing this, you have only $6,000 exposed to the checking account tax instead of $20,000. You have reduced your exposure by 70%. The final step is to automate the sweep. Set up a rule so that every payday, any amount over your buffer gets automatically sent to your spokes. This removes the need for discipline. Your money starts protecting itself. You have built a system that fights inflation for you 24 hours a day. The $20,000 in your checking account is a ticking clock. Every day you leave it there, you are paying a price for the illusion of safety. The checking account tax isn't a theory, it is a mathematical certainty. But you have the tools to stop it. You now know that a bank balance is a moving target, and that the real goal is purchasing power, not just a high number on a screen. No one cares about your money more than you do. Your bank is a business designed to maximize its own margin, and it will happily let your wealth erode if it helps their bottom line. By breaking the spell of the money illusion and setting up a hub and spoke system, you are taking back control. I want to hear from you in the comments. What is the APY on your current checking account? Let's do a peer review of these banks and see who is actually treating their customers fairly. It is time to stop subsidizing the profits of the big banks with your hard-earned savings. Move your cash, set up your buffer, and start earning what you are actually worth. Thanks for watching, and remember, keep your money moving, because if it stays still, it is shrinking.